Hi everyone, welcome back to the Technical View, where we just take a classical technical analysis view of the overall world markets. You know, we've got the S&P 500, we've got the Shanghai Composite, we've got the FTSE, we've got the BSE 30 in India, and we've got the All Ordinaries as well. And you know, it's just a really cool way to see where the market might be heading and to sort of, you know, even to supplement your own ideas, your own research that you have going in your own world already. So we're going to start with the S&P 500. Very simple stuff. Last week, what we were talking about was this resistance. You know, pretty plain to see, was at that 2100 level. Obviously, it had to break above there in order for the uptrend to continue. Now that did not happen. So what we're left with is we've got two peaks, two troughs. That's your classic continuation pattern, but only if it breaks out to the upside. So at this stage, it does not look like it's going to break out to the upside. And in fact, what we'd be looking for, we've got the 50% level at 1990. So that would be your next support. And at 75%, we've got 1930 would be our next level as well. So, you know, those are your two sort of main levels of support on the S&P 500. One thing that I did want to call out as well, and you're going to see this on every single market that we look at today. Now, probably other people are saying this as well. Maybe they are, maybe they're not. But, you know, as plain as the eye can see, from a classical technical analysis point of view, it's the old head and shoulders. Now, you know, I don't put much faith in the head and shoulders myself, except for one thing. And that is that it actually makes sense when you think about the technical aspects of it. Now, just really quickly, we've got, you know, if we've got higher peaks and higher troughs, that's what it takes to make an uptrend. You need higher peaks and higher troughs to make an uptrend. And that just goes back to Dow theory, which is from the late 1800s. It's literally been sort of been a part of the market for the last 130 years, probably longer. Now, obviously, the downtrend is lower peaks and lower troughs. So if we're looking at a head and shoulders, you know, in quotes, a head and shoulders pattern, what's the first thing that happens? It's a lower peak, isn't it? So obviously, you know, from a technician's point of view, it's not just a head and shoulders. It actually makes sense from a lower peaks and lower troughs, and therefore a new downtrend point of view. Now, I did want to show you as well. I mean, now, again, this is scaremongering really, but you know, when you look at the patterns, it does make sense. This is back in 2008, so 2007, 2008, and yes, we're looking at the high peaks, high troughs here, or the head and shoulders, as you might say. And then what have we got? The lower shoulder on the right-hand side here, and that's your lower peak and lower trough, and that's when it just goes completely off the edge about July to October 2008. And if we were to look at where that actually goes to, it sort of drops and finds support at 100% of that previous move. So from the head to its sort of neckline or where it breaks, it usually drops about 100%. So we've got the FTSE in Europe as well. Now, just coming up to today, and again, you know, the thing with classical technical analysis, and you know, I use actual trading systems that are validated in my own trading and investing, you know, personally. But this stuff is still very interesting to get into. Obviously, this sort of pattern is unfolding on the FTSE in Europe as well. So again, if you know, worst case scenario, from the head to the sort of break of the neckline, well, you know, that could get quite ugly at about the 4,700 level. So back to 2011 sort of levels if that were to break and go that far. One thing that I do need to call out is in 2010, 2011, as this second pattern unfolded after the financial crisis, so there we go there, is it actually didn't eventuate. So it didn't break through the neckline, in other words, that being the neckline. And as you can see, that's 2010, 11, 12. So it actually found support, you know, before that neckline. And because of that, the bull market continued. And obviously it broke out from resistance up there at about 5,800 and continued on for another year and a half, which was fantastic. Looking at the FTSE as well, it did have that similar pattern in 2008. So there you go. You've got your sort of shoulders, head, the lower peak on the right hand side, and then over the cliff. in about October 2008. Next, of course, let's check out the BSE 30 in India. This one, the last time we did look at this, basically we're looking at that trend line. Again, similar scenario. I was saying it would have to sort of break above that trend line in order for the uptrend to continue. That has not happened, and in fact the market has fallen away even further since sort of touching on that trend line there, which is really cool. I mean, that does happen quite a lot. So what we're looking at now is a bit of a channel type scenario, and in other words, if we extend the bottom part of that channel, then the support for the BSE 30 is about 24,000. And again, if that level sort of breaks, then it's not a good thing. That's your next level of support. Second last is the Shanghai Composite, and again, last week we were just saying how this, even though it's moving up, it's technically in a downtrend as far as I'm concerned. The reason is because this is a really flat sort of move after a downtrend. So we've got the downtrend. It's a really flat sort of continuation. It looks to me more like a continuation pattern. We've got trigger points that we want to look for. Now, if it was to break out to the upside of this level here, then that's about your 3,700. Now, if it was to do that, then that you could sort of consider that the uptrend is continuing. If it breaks down to the downside, then that's your downside continuation pattern moving on from there. It's really just a line in the sand. Now, last but not least, let's check out the All Ordinaries. Obviously, you've got your shoulder, your head, and then your right hand shoulder, or your right hand lower peak. So looking at that, again, just going back over history, similar thing happened in 2011. Now, these are multi-year patterns as well. So as you can see, we've got 2010, 11, and 12. These are 3-year patterns. I mean, they're huge, but that's also, it was a 2-year pattern, or, pretty much 2 years that happened in 2008 as well. When that neckline was broken. So really, what we're looking for support on the All Ordinaries is that neckline. And let's just say I wouldn't want to be long if that neckline breaks, because obviously just looking at what's happened in the past, and I mean, I guess the rules of this pattern always say that it drops around that 100% level. Things could get pretty ugly. It doesn't necessarily mean that it's going to go all that way, but it's just one of those, it's one of the rules of that pattern. But overall, pretty cool. It's a great another way to look at the market, or at least to get another point of view. Obviously, do your own research as well. Guys, check out my site, it's asxmarketwatch.com. I have a whole bunch of trading systems there, a course on AmiBroker trading systems as well, trading system coding, technical analysis as well, market research, a whole bunch of stuff for free. Check it out, it's absolutely fantastic. Happy trending until we meet again. Have a great week, guys. Bye for now.